For this morning, there's the agenda. It's fairly regular. Vic is going to speak shortly on a review of the strategy in the quarter and give some thoughts on the outlook as well. And then Seb is going to give a bit more detail on the sustainability disclosure requirements, which were published at the end of last year by the FCA in the UK, and a really important development for our industry here in the UK, and will have ramifications overseas as well, we think. So without further ado, I'll hand over to Vic. And let her take it from here. Thank you.
Thanks, George. Good morning, and thanks again for joining us today. I'm Victoria, and I'm an associate fund manager here at WHEB on the investment team. I'll be taking you through a little bit of background to the quarter and how the strategy performed in light of that before taking you through a little bit of outlook. So this first slide gives you an overview of our longer term performance, and you can see that the strategy has underperformed over that period. I think it is worth noting the positive absolute returns, and what we have seen over the last 6 months is a strengthening of those returns, both from an absolute and a relative perspective. It's worth bearing in mind also that that period does encompass quite a lot of disruption. So we've seen numerous sort of economic challenges. We've seen quite major monetary policy shifts, as well as supply chain challenges, and not to mention the impact of COVID. Another dynamic we've seen has been an increasing narrowness of returns, with the index driven by fewer and fewer stocks. And we've got a slide on that a bit later on. Another thing worth noting is that the strategy has generally outperformed our own internal universe. So what you see here is, in large part, the beta of that sustainability focus. Stock selection against our opportunity set has been positive. And I think importantly from our perspective as well, the fundamental performance of the underlying businesses has been broadly resilient in what has been a very difficult environment for many of them. So if you remember maybe from the last webinar, the fourth quarter was really characterized about optimism about the direction of interest rates and inflation. And I think this quarter has really seen much more of a reality check. We've seen inflation falling at a slower pace, and in January and February, the inflation number came in higher than expectations. And that's led to the market scaling back its expectations for interest rate changes this year. The chart on the left shows that the number of rate cut expectations has more than halved for both number of rate cuts expected by June and by the year end. So by December, the market is expecting now fewer than 3 cuts, whereas previously they were expecting more than 6. The chart on the right shows that the scale of those cuts has also come back. So at the peak, people were expecting a cumulative cut of about 1.6% by year end, and that is now sort of hovering around the 0.6% mark. Since the end of the quarter, expectations have continued to worsen, and the FT even had headlines now about probability of rate increases coming back into the picture, and that's something we will touch on in the outlook slides. One of the big drivers behind that change in sentiment has been the strength of the US economy. And one notable data point has been US manufacturing activity in the PMI, which you can see on this chart. Anything below 50 is considered a contraction, and anything above 50 is growth. And it's been something that's been watched quite closely by the market, because any period in sort of historically where it's been negative for more than 14 months has typically been a leading indicator of a recession, and we were getting to the point of 16 months. So that's really been taken positively in terms of the strength of the economy. Other indicators have also turned more positive. So consumer confidence is growing, and so is consumer spending on goods, which has been lagging spending on services to date. A newer topic for this quarter has been the outperformance of the Japanese market. So the central bank in Japan voted to raise interest rates for the first time since 2007. And up until that point, it had been the only sort of developed market economy that was still running on negative interest rates. So the central bank is really trying to put decades of deflation in the rear view mirror. And the market performance suggests that there's confidence that that kind of higher inflation is going to be persistent and flow through to economic growth. The second driver that is maybe more interesting from a sustainability perspective is that some of that strength has come from an increasing focus on corporate governance through the new stewardship code. That's targeting things like complicated cross-shareholding structures and high cash balances, which are a feature of many Japanese companies. That's all aimed at improving capital efficiency and ultimately achieving higher shareholder returns. So those are developments that are ongoing and things that we will watch in relation to our own holdings. Back now to perhaps more of a recurring theme from some of our webinars and the performance of the Magnificent Seven. As a whole, the group did still outperform, but as you can see from this chart, that's been driven this time more by a FAB 5, and really there's only been one game in town, with NVIDIA driving really the bulk of that outperformance. Now, that has implications for our exposures because the performance of NVIDIA has driven a lot of optimism in areas of the market and the value chain that are tied into the AI theme. And the underperformance of companies like Tesla and Apple also has implications further down the value chain. And we'll come on to some of those elements a little bit later on. Now, looking through to how that has tied into the strategy performance, the fund has underperformed over the quarter. We had a difficult January, although we did see stronger performance in subsequent months, both relative and absolute. Clean energy was a big headwind during that period, particularly in January, but it didn't recover through that period. On the other hand, health saw positive absolute returns, and that was driven by GLP-1 related stocks, but also some of the life sciences and tools companies, which are seeing green shoots in terms of their recovery. Mid-cap growth, which is a style factor that the strategy is overweight, also saw positive returns and kept up pretty well with the benchmark. But as you can see from this chart, despite those positive returns, all of those areas still underperform the MSCI world benchmark. And that really is a function of that narrowness, which we saw in the previous slide. Now, you can see many of those elements reflected in the thematic performance of the portfolio, with clean energy and sustainable transport, the clear underperformers from an absolute contribution to return perspective, and then health much stronger. Resource efficiency underlying that, the stocks were mixed, but the outperformance was driven in large part by Trane Technologies, which we'll come on to, and also Schneider Electric. Environmental services had quite a strong sustainability flavor to its positive performance. So within that, advanced drainage was strong, and that's really being driven by kind of the climate adaptation narrative and the increasing number and severity of climate events. And then Arcadis, which is an engineering consultant, again being driven by sustainability and increased investment in environmental projects and climate. And then finally, water management is also worth touching on. It's seen sort of increasingly positive sentiment, in part driven by new US legislation, which sets quite strict standards for PFAS or forever chemicals. Moving through to some of the themes and why they underperformed in a bit more detail. Within cleaner energy, solar was the key kind of area of underperformance. And that was driven in large part by overall sort of weaker demand levels and increasing Chinese exports. Now you can see the sort of uptick in Chinese exports in that chart on the left-hand side, and that's being driven by weaker demand because of the weakness in the Chinese economy. And that's resulted in cheap solar panels flooding the European market. The FT had quite an interesting report about how consumers are getting creative with that cheap supply. So with solar panels, the main cost of installation is the labor and the scaffolding. So people are taking a bit of a DIY mentality and putting lots of them in easy to install places like a fence, which you can see in that picture, without necessarily worrying too much about whether it's the optimal location, i.e. a roof. So what we've seen really is the European solar market that's now in crisis, and Meyer Burger is a pretty sobering example of that. They are Germany's biggest panel producer, and they are planning to shut one of the largest plants in Europe, and have raised equity to shift their focus more towards the US. And we see that really as the tip of the iceberg if nothing changes. So there's now pretty significant pressure on Brussels to respond if Europe wants to have any chance at remaining in any way competitive in this market. The other area where Chinese supply and policy has had implications is in electric vehicles. We don't actually hold any car manufacturers directly, but it does impact companies in the supply chain like Aptiv, which is a tier 1 supplier, and Infineon in the semiconductor space. Now, Tesla has been the poster child for that dynamic after it saw a decline in deliveries this quarter, but other more electric vehicle focused companies have been impacted. So BYD in China, you can see their weaker share price performance. And also Fisker in the US, which is now pretty close to bankruptcy and has been forced to delist from the US stock market. There are a number of reasons why EVs are under pressure. One of those is the growth of availability of cheaper Chinese brands. A second is that the industry across the board has seen quite significant price cuts to counter weak demand. And then in the US, more specifically, there are concerns about a lack of charging infrastructure, which is another kind of headwind to appetite for consumers to buy electric vehicles. Additionally, in the US, we've seen changes to the tailpipe emissions rules. The new version of the rules were revised to allow for a slower adoption curve, and they also allowed non-plug-in hybrids to be included in the target proportion of non-combustion engine vehicles. And all of that taken together has led to the outperformance of legacy car makers versus more electric vehicle focused, and you can see that quite clearly in the chart on the left. The debate for us is really whether that is a speed bump or more of a structural challenge. And I think it is worth bearing in mind that the US is specifically quite different to the rest of to other markets. So China, for example, is far ahead of the rest of the world in terms of adoption. We are seeing affordability improving across the board, and we are seeing increasing investment in charging infrastructure. And although in Europe we have seen bits and pieces of incentives being changed or rolled back, we do see the overall regulatory environment still is supportive in the long term, particularly with the ban by 2035 still in place. To achieve that, there does at some point have to be a tipping point in EV demand. And that takes us through to the performance of stocks within the quarter. And there's a reasonably mixed bag of contributors, both on the top and bottom end. You can see the clean energy headwind coming through with companies like Vestas, SolarEdge, and Nextracker. And you can see the impact of the EV headwind with companies that I mentioned like Infineon and Ansys. In terms of positive contributors, again, you can see that health theme coming through with companies like Lonza and Icon strongly performing, and then Ecolab within the water theme, which has seen that sort of more positive momentum. So the next few slides will just take you through a couple of stock-specific examples within those names. And the first of those is Trane Technologies, which is a global leader in HVAC systems and also climate-controlled transportation. One of the nice reasons to talk about Trane is that actually nothing much has happened in this quarter. They have just consistently delivered very strong results. And the chart on the left shows that revenue growth has been above 10% for quite a consistent number of quarters. In this quarter in particular, they gave an outlook for 2024 that is supported by record levels of backlog, and that was taken positively by the market. Train is also making good progress on the impact side of what they're doing. And they quantify that in terms of their so-called gigaton challenge. That's the aim of removing 1 billion metric tons of CO2 emissions from customer footprints. And to put that in a bit of context, that is the equivalent of the emissions of Italy, France, and the UK combined. So initially, we were a little bit skeptical of that. It sounds very large, but we've engaged with the company, and we're confident that that is the way that they're approaching that is robust. The way they're measuring it is science-based, and that it is something that it's very much a stretch target, but is something that they can achieve. And they have already reported that they are now close to achieving 10% of that, having removed 9 million metric tons of CO2 from the environment since 2019 from their customers' footprint. So that does leave a fair amount to do in the remaining part of the decade. And to achieve it, they are accelerating the use of high efficiency equipment. They're expanding electrification, and they're also aiming to grow revenues in the temperature controlled transportation part of the business, which reduces food loss in the global cold chain. And that's another nice example of how we see impact as very much correlated with the investment thesis, because it supports those underlying growth drivers of the business. They're also increasing the use of low emissions refrigerants and encouraging customers to use their reclamation services of those refrigerants more. So you can see they're really focused on the whole life cycle of the emissions footprint and the impact, which we see as very, very positive. Another strong performer during the quarter was Lonza. Lonza is a contract drug manufacturer, and it focuses very much on biologics and advanced therapies. During the quarter, the company announced the acquisition of large-scale facilities from Roche, and that additional capacity enabled them to upgrade their growth target over the medium term from 11 to 13% revenue growth to 12 to 15% revenue growth. Now, the broader life science industry in the pharmaceutical value chain has had a pretty difficult couple of years sort of post-COVID, and we're starting to see the early signs of a return to those structural underlying growth rates and drivers that underpin our investment case for these companies. And the performance of Lonza over this period is a nice example of that. Turning then to stocks which have underperformed over the period, and the first of those is Vestas, the wind turbine manufacturer. Now, they actually had a very strong fourth quarter from a sort of fundamentals and stock performance point of view, with a strong beat on orders and margins, which are both metrics that are pretty closely watched by the market. And you can see the extent of that in the chart on the left. The first quarter is expected to be lower in terms of order intake. And in many ways, the stock is just taking a breather from that strong performance in the fourth quarter. It's also worth noting, though, that those estimates are based on announced order intake. They don't include unannounced orders, and that can make up quite a significant proportion of the final figure. So the uncertainty about whether that final number will match expectations has also weighed on the stock. Then within sustainable transport, Infineon, a semiconductor company, has been a key underperformer. Now, in many ways, Infineon is just in the sort of wrong part of semiconductors at the moment, because it hasn't got a large exposure to the AI theme, which is driving a lot of outperformance within the sector. And it does have exposure to autos and industrials. And it's really that automotive segment that's the key debate among investors. You can see in the chart on the left that performance up until this point has been pretty resilient, and the main headwinds for Infineon have actually been in the more industrials-focused parts of the business. The market is expecting a guidance cut in the auto segment, and it's also worried about Chinese competition increasing. Management remain pretty confident, and they are still targeting low double-digit growth for the auto segment for the full year. Now, pricing is one of the reasons they have that confidence. The pricing environment has been pretty supportive for them still, and they're also seeing an increasing amount of content going into electric vehicles and also the sort of automation technology, which is helping offset some of the wider kind of car industry volume headwinds. And in terms of competition, Infineon recently announced that they have gained the #1 position in a technology called microcontrollers after a period of quite strong share gain. And that's an area where Chinese competition lags pretty significantly in terms of their technical capability. And it's an area where it's quite difficult to switch technology to another provider. So again, it's something we're cognizant of, but reasonably confident in Infineon's position. So overall, we are conscious of the cyclical risks for Infineon, and we've sized the position accordingly. But as this chart on the right shows, we still do see strong structural underlying growth drivers for the business in that medium to long term. And that's very much driven by sustainability, and it's in areas where Infineon is really the market leader. So moving then to outlook and the debate, which has really been a major driver of markets for such a long time, inflation and interest rates. You can see in the chart on the right that long-term expectations for some of the major developed economies are broadly around the target mark. It's the path to getting there that remains uncertain. And over the last few weeks since the quarter end, we've seen inflation has once again proved to be more persistent than many had expected. The conflict in the Middle East is propping up energy and commodity prices, and the labour market also continues to be strong. So Jay Powell really has an unenviable challenge. The Federal Reserve has to balance the performance of the economy against inflation rates with the aim of achieving a so-called soft landing. And many are skeptical that that's achievable, and the persistence of inflation is fueling that view. At the moment, the Fed seems to be favouring controlling inflation over allowing the economy to grow faster. But that balancing act is a really difficult thing to pull off. And I think that's one of the reasons why the market tends to move so quickly and sharply on any data that moves the needle significantly in either direction. 2024 is also set to be a pretty major election year. The UK is probably going to head to the polls at some point this year, and the US is likely set for another showdown between Trump and Biden. Now, it's difficult to predict how the outcome will affect markets, but it does create opportunities for further volatility. A Republican government is largely perceived by many as sort of bad for sustainability, but good for stock markets, and probably vice versa for the Democrats. We try to avoid being too influenced by the noise, but I think it is worth considering one of the key areas of policy risk that's relevant for some of our cleaner energy holdings. So there are concerns that a Republican government under Trump would move to unwind Biden's climate policies and legislation. Biden has earmarked more than $50 billion to go towards climate-related projects through both the Infrastructure Law and the Inflation Reduction Act. Now, the Infrastructure Law was passed with bipartisan support, so that is probably slightly safer. But Trump has been very clear that dismantling the IRA would be at the top of his to-do list. Now, it has been passed as legislation rather than going through an executive order, and that makes it procedurally more difficult to unwind. And it's also spurring quite a lot of investment that could lead to a lot of job creation. You can see that in the chart on the left. And a lot of those jobs are likely to be created in Republican states like Texas and Florida. And so Trump is likely to face pushback from within his own party, particularly in relation to the manufacturing credits, which is the main lever for that job creation. The EV tax credits, on the other hand, are much more vulnerable. In combination, they could reduce the cost of electric cars and trucks by nearly $8,000, and it's an element that pulls particularly badly with Republican voters. So if that was to be repealed or removed, it would set back the US's trajectory on emissions by potentially hundreds of millions of metric tons this decade. Now, one thing we've seen is Biden potentially trying to accelerate some of the spending because once it's committed, it's much harder to pull back on the funding. Now, finally, it does seem quite often like there is a lot of negativity kind of swirling around about sustainability. And so we wanted to take the opportunity to reiterate our confidence in the structural opportunities. The first of those is increasing investment in buildings and infrastructure. And a lot of that is driven either by regulation or by companies increasingly setting their own emissions reduction targets, which is then driving investments in efficiency and improved performance. We've already seen how Train is benefiting from that by providing customers with solutions to those needs. But it's also a driver behind Schneider Electric, for example, which has been another strong performer over the period. Elsewhere, you've got Autodesk in the software space that is focused really on the design stages of some of these projects. And then you've got Silicon Labs, which is involved in kind of monitoring and managing aspects because its technology provides connectivity across the Internet of Things. A second area with continuing strong opportunities we see is within health. And one example of that is the kind of incredible performance we've seen of GLP-1s in terms of addressing obesity and diabetes. And you can see that driving the growth opportunities for companies like Novo Nordisk, for example, which was a recent addition to the portfolio. But it also drives growth across the value chain. So one example might be ICON, which is a contract research organization that would benefit from the growth in trials, for example, for proving the benefits elsewhere outside of diabetes and obesity. And one area that's getting a lot of focus is the potential in Alzheimer's, for example. And then you've also got companies who have additional products in the kind of GLP-1 space. So AstraZeneca is one example, and that's that growth in the pipeline is it creates an opportunity for longer-term growth. The other area we've already touched on is the opportunity in water, which is again one that's gaining traction. So the PFAS legislation I mentioned earlier could benefit companies like Ecolab, Xylem, and Arcadis. And we're also seeing opportunities in climate adaptation. And I think we touched on advanced drainage systems in previous webinars and the opportunity they have with it. So they make stormwater pipes that are mainly made out of recycled plastic. And they're seeing that increased opportunity from climate-related events. And that's really one of the drivers behind adding adaptation as a sub-theme, which again, we talked about in the previous quarter. The uncertainty of the interest rate and inflation sort of debate does create a tough environment for impact investors. But we see the bottom-up opportunity as very much intact, and we do remain positive on the potential of the portfolio. And so with that, I will hand over to Seb.
Very good. Thank you very much, Vic. Let me just share my screen. So good morning, everybody. My name is Seb Beloe. I'm a partner and head of research here at WHEB, and I'm going to be talking to you for about 10 minutes about the sustainability disclosure requirements that the FCA launched at the end of last year. Some of you may remember, actually, if you were at our annual investor conference, that was the day, actually, that the FCA published their policy statement. It feels like a very long time ago now. It's not really that long ago, but it's only now that the market is really beginning to get to grips with what this all means. And in fact, we had a meeting with the FCA on Friday, where we were talking to them about our approach for the sustainability impact label, which is the one that we will be hoping to use. So the SDR is really the UK's approach to providing a bit more structure and clarity in the sustainability investment market. The aim is fundamentally to help consumers and their advisors navigate the different types of sustainability investments that are available, and also to make it more difficult for asset managers to label their products as sustainability investments unless they really are focused on achieving clear sustainability objectives. So I'll talk a bit more later on about what we think of the policy statement, but in general, we very much welcome it. We think it's very important to have clearer guidance from the FCA as to what they think asset managers need to do to label and market their products as sustainability investments. I don't know how many of you bothered to download the 200 odd pages of the policy statement, let alone actually read it all, but I've pretty much read it all. So I'm going to try and highlight some of the key points that we think are important, and as well as how WHEB is planning to respond to it. So this is a stylized map of the investment landscape that actually appears in the policy statement, and I think it provides a helpful overview of what the FCA is seeking to achieve. The first point is that it is quite complicated, but at least from the FCA's perspective, the key point is that they're trying to draw a bright line, which is shown by that dotted line, between, on the left-hand side, investment approaches that just have sustainability characteristics, and those on the right-hand side that specifically target particular positive sustainability outcomes. So on the left-hand side, there may be many reasons to use sustainability data in your investment approach. For example, you may think it helps you avoid risks or find opportunities. And fund managers have developed a variety of approaches to use sustainability data to do this. For example, through ESG screening and integration, or through stewardship or other types of positive or negative screening. But unless the approaches are specifically aimed at achieving a positive sustainability outcome, as opposed to just a financial outcome, then products using these approaches will not qualify for a sustainability label, nor indeed will they be allowed to use terms like sustainable or sustainability or impact in their naming and marketing. In contrast, products on the right-hand side will have a stated intention in their sustainability objective to achieve positive sustainability outcomes. This might be, for example, to invest in assets that are considered to be environmentally or socially sustainable, which is the requirement for the sustainability focus label. It might be to invest in assets that have the potential to become sustainable over time. That's the improvers label. Or to invest in assets that achieve a predefined, measurable environmental or social impact, as is the case for the sustainability impact label. Or the product can have a mix of all three, which is the mixed goals label. So the FCA really, what they've done is they've taken a look at the market today and identified these three types of approaches that I think we all probably can recognize, and we think that makes sense. But the focus of the policy statement is really to require real rigor in how managers address these different areas. And so these are the three labels. The fourth is obviously the mixed goals, which is a combination of those other three. The FCA do not want this to be seen as a hierarchy, and certainly from our perspective, we also see that each of the approaches has a role to play. The sustainability focus, as I said, is primarily focused on assets that are environmentally or socially sustainable. So, for example, this might be an approach that invests in assets that are aligned with the Paris Agreement on tackling climate change. As the manager, you then have to set key performance indicators that measure the ongoing sustainability of the assets that you've invested in. And any stewardship that you do must be explicitly linked with this. So, maintaining the ongoing sustainability of those assets. With improvers, if we use that climate change example, the objective here would be to invest in companies that have the potential to be aligned with the Paris Agreement, and then the key performance indicators have to track progress against that objective. So how are the companies that you invest in, or the assets that you invest in, how are they becoming more aligned over time with the Paris Agreement? And clearly, stewardship is the key element in the improvers label in getting companies to improve, to become more aligned. And then finally, with the impact, the sustainability impact label, here the objective is to invest in assets that achieve a positive, measurable social or environmental impact. So sticking with our carbon theme, the objective here would have to be something like investing in assets that provide solutions to climate change by reducing carbon emissions. And again, the key performance indicators would need to be focused on measuring the positive impact, for example, through tons of carbon emissions that are avoided, or megawatt hours of renewable energy. And then the stewardship would need to be focused on that specific objective. In other words, engaging with companies to encourage and support the delivery of their positive impact. So that's basically the three labels in a bit more detail. On the right, we've got a little pie chart here, which is one of the relatively few bits of data that we've seen trying to forecast how the market is going to embrace these different labels. The FCA themselves have said that they only think about 5% of funds on the market in the UK will seek to have a label. That's about 300 funds. And then Morningstar have did a piece of work a couple of months ago that tries to forecast which labels are going to be most popular. And in their research, which largely tallies with our view, I think, is that the sustainability focus will probably be the most popular label. Around 40% of labeled funds will be in that category. About 30% will use the mixed goals label, and then 14% in improvers and 11% in impact. So at one level, all that sounds quite benign, really, and largely reflective of the types of product that we see on the market today already. But the real challenge from our perspective as asset managers, and the real value as well, is that the SDR is really focusing on making sure that these objectives run through the whole investment process, like the figurative stick of rock. So for all of the labels, of the 4 labels, the first and most important thing is the articulation of the sustainability objective. This needs to align with one of the 3 labels and needs to be clear, specific, and measurable. This then needs to be implemented through a sustainability investment strategy and policy. This needs to show how assets are selected using a, quote, robust, evidence-based measure of sustainability, standard of sustainability. And this has to be an absolute measure as well. So, for example, selecting assets on the basis of ESG ratings is definitively not considered sufficient for any of the labels. So, for example, if the objective is to invest in companies that are aligned with the Paris Agreement, as we were saying earlier on, then the robust measure of sustainability that is used for asset selection must be based on an absolute measure of the asset's carbon emissions. We can't use ESG or a relative rating. In each case, each of the labels, you have to have at least 70% of the assets need to be aligned with the sustainability objective that you've set, and none of the remaining 30% can be invested in assets that undermine that objective. This will probably make it very difficult for passive funds to fit in the improvers label. That's probably the one that they're most likely to fit in, as they would need to show how they are engaging at least 70% of the assets in the fund in order to qualify for the label. And then there are also requirements in terms of resources and governance that you have to demonstrate as a manager. And then the KPIs that we've talked about already, they need to link directly to that objective. So for us, with our sustainability impact label, the KPIs need to show how we are achieving our objective. So, for example, how our investments are leading to reduced carbon emissions that we have to measure, or on the social side, how they're leading to better healthcare outcomes, more education, and so on. And this applies to the stewardship as well. You have to have KPIs for your stewardship activity, and this too needs to be directly aligned with the sustainability objective. So, for example, if that objective is about tackling climate change, then the stewardship you do needs to be focused on climate change if you want it to support your use of the label. So work on wider issues like diversity, while very valuable, would not be seen as contributing to the label that you're selecting. So this is all quite demanding, actually, and we think we're pretty well placed because we've always been very clear about our intention to have a positive impact, and the measurement we do through our impact calculator and so on should be very helpful. But there is a lot of work here to make sure that you're being clear and aligned and consistent through your entire investment process. And one of the things that the SCA go on about is that these are retail labels, And so their guiding principle really is that it needs to be clear and understandable to a retail investor. And that's what you have to bear in mind as you're developing your submission for the FCA. So ultimately, what do we think the impact will be? Well, we do think it's going to be substantial. As I said earlier, the regime is intended to capture strategies that are already on the market. But what the SDR introduces is requirements for a much more rigorous approach in showing the sustainability objective that you've set for yourself is central to the activities of the manager, and that you have to document and report this quite extensively as well. We do welcome it. We think it really will force anyone who wants to use a sustainability label to really think hard and invest in the capacity to do this properly, and also to make it understandable to retail investors, which ties in with the consumer duty requirements. Again, we think we're pretty well placed because having a positive impact is something that retail investors generally get pretty intuitively. So we're confident, fingers crossed, that we'll be successful in our application to use the sustainability impact label. A couple of other points just to make before I finish. The approach is principles-based, is principles-based, yes, rather than prescriptive. Again, we welcome this. It does make it more difficult to start with because it's not always entirely clear what the FCA are looking for. And we had our meeting last Friday with them, which was very helpful in clarifying a few points. But over the longer term, we think it's a much better approach than the more prescriptive route that the SFDR has taken so far, which is very rigid, really, and prevents innovation, and ultimately we think is a less efficient approach than the approach that the principles approach that the SDR uses. And then finally, for the impact nerds among you, we were relieved to see that the final policy statement did not focus on concepts like additionality and causality, but instead focused on intentionality and contribution. In other words, you have to show as an impact manager that your investment policy and process is focused on delivering impact. That's your intentionality. And you also have to measure the ultimate outcome that you're aiming for in terms of avoided emissions or better healthcare. But you don't have to prove that it happened because of you. That's the additionality and causality point, which we think is pretty much impossible in listed markets or in many markets. And so we think this focus on contribution and on intentionality is the reasonable standard to set. The SDR is complemented by anti-greenwashing rules and by naming and marketing rules. And in fact, yesterday, the FCA published a consultation paper on how the SDR framework will apply to model portfolio services. We also believe that in time, they will roll this approach out to institutional markets like pension funds as well. So the next step, just with the timeline at the bottom, is the anti-greenwashing rules, which come into force at the end of May. The model portfolio services consultation ends in the middle of June, and then managers can start using the labels themselves at the end of July. The naming and marketing rules and the MPS rules will come into force in December. And at that point, managers who do not have a label will not be able to use terms like sustainable and sustainability and impact and environmental. There's a whole range of words that they won't be able to use in their naming and marketing. So I hope that's helpful, and I think we have a few minutes still for questions, so I shall stop sharing my screen. Thank you.
Great. Thanks, Seb. Thanks very much for that. And Vic, before that, we've got some questions coming in on the Q&A function on Zoom, so please do continue to add to those. We've got 15 minutes or so to try and get through your questions. Just as a starting point, Vic, can you just describe a little bit more about the portfolio activity during the quarter? You know, what was in, what was out, what changes did you make?
Yeah, so we had 2 new additions to the portfolio and 2 sales on the other side. So we added Novo Nordisk, which I touched on during the presentation. We think it has significant long-term opportunities from that GLP-1 and potentially newer types of drugs, also in the obesity and diabetes space, which provide a really attractive opportunity. We also initiated a company called Siemens Healthineers, which is a company that has products across diagnostics, imaging, and sort of medical technology areas. We think they've got significant room for improving their margins. They have strong structural drivers in the healthcare space. And again, we see a very attractive valuation opportunity for that one. On the other side, we sold JB Hunt. JB Hunt is a company that we've held, I think, since 2012. So it was a long-standing name within the portfolio, and really there were no major concerns about JB Hunt. I think we were just seeing a bit of a slowing of the shift towards intermodal, which is freight moving from just being truck transported to a combination of rail and truck, which significantly reduces the emissions of logistics sort of supply chain areas, and that shift had slowed down, and I think we just saw better opportunities elsewhere. And the other one that we sold during the quarter was Tomra. Again, Tomra is one that we still see long-term opportunities for in terms of the increasing requirement to recycle plastic, but there have been a number of policy headwinds for them, with a number of markets delaying the introduction of deposit return schemes, and that sort of pushed out that growth profile and creates quite a lot of uncertainty. And I think the fact that we're in an inflationary environment and the consumer is under pressure from that makes it quite a difficult policy to implement, because it's perceived as putting higher costs on consumers, and so it's politically quite difficult to implement. So there's just quite a lot of uncertainty in the near term, and again, we felt like there were better opportunities on the other side of that.
Great, thanks, Vic. And just following straight on from that, because it's sort of linked, I mean, you've just given two examples with Tomra and JB Hunt, but there's another question asking more generally, just to talk through the process we use when making decisions to sell stocks that are no longer within the investment criteria. I guess that's both from a sustainability but also from an investment perspective. So what criteria do we use to identify and decide when to sell either underperforming stocks or perhaps underperforming stocks as well, when it's right to exit?
Yeah, I mean, I think it can be a mixture of any of those things. So for each of our companies, we set out at the beginning what our thesis is, what we're looking for, and what the risks are. And I think key reasons for selling would be a shift in the company away from thesis or not achieving the kind of what we're looking for. And then on the other side, any of those major risks starting to materialize. Those would be the key drivers. And then on the impact side as well, a decline in the positive impact, or for example, if they sort of reached a point where they were no longer above that 50% threshold. Valuation can be a reason if a company just gets too expensive. And we would typically, if we're seeing higher valuations in a company, what we would do first is sort of bring the weight down within the portfolio rather than necessarily immediately sell out. And then you have the ad hoc reasons where something sort of major changes within the business, sort of negative surprises that would potentially result in a more kind of immediate sell decision.
Okay, thanks for that, Vic. I'm going to stick with you just for a moment, and also another question, which leads on from what you were some of your presentation on rising US debt levels. So, do you think the US can continue to fund the Inflation Reduction Act, the IRA, in the foreseeable future, given the debt levels that continue to rise in the US?
Yeah, so the argument behind a lot of the investment from the government on the climate policy is that it actually has a net benefit for the economy. So you've got the cost of the tax credit, but you have the benefit of jobs being created, the benefit that is created from increasing private investment and spending, resulting in higher taxes in another way. But you've also got the avoidance of the costs of climate change. So the social costs from the health implications, the costs of coping with the damage from storm events. And so all of those things are costs which are avoided if you put in this investment. So short term, yes, there are potential implications for the budget, because the way that they work is generally a tax credit. So you've got a reduction in the tax income of the government rather than an outright spend. And you have seen the Republicans try to use the debt ceiling as a way to try and prevent the climate plan going through, and that was unsuccessful last year. So broadly, we think this is a good thing for the US economy. It hopefully helps them invest in innovation, keeps their competitive position. And you can see that already in the way that I mentioned Meyer Burger. Companies want to be in the US. They see the opportunity there. They are investing in manufacturing capacity there. So the net, the idea theoretically and what we're seeing is that it should be a benefit for the economy.
Right. Okay, thanks, Vic. We're going to give you a rest for a moment. And a couple of questions come through for Seb following on from SDR. We also had the final policy on the anti-greenwashing rule yesterday, Seb. And so there's a question saying, do we have any concerns about the implementation timetable for the anti-greenwashing rule, which I think is due to be implemented by the end of May, and the extent to which the revised guidance provided additional clarity for firms?
Yeah, no, I don't think we do. I mean, our kind of interpretation of the anti-greenwashing rules is a sort of extension of other consumer duty obligations that we have in terms of being clear, fair, and not misleading. We've always, I mean, there are particular criteria around having to substantiate any green claims that you make, which we do. You know, the data that we report publicly is all got, you know, there's always a methodology and a data source behind it. So we're pretty comfortable that that we're already doing that and have done it for a long time. So yeah, at this point, not particularly worried about that.
Yeah, I think it's great. You know, I think generally we're very pleased to see the bar raised overall and that those standards tightened up. It'll be good for the market and consumer confidence as well. Just more broadly in SDR, we're obviously looking to use the impact label at the earliest opportunity. We're working towards doing that. Question: are we expecting to change anything in the way that we work, in the way that we manage the fund, or material that we publish in order to use that label?
Well, no, we're not. I mean, one of the things, the timeline for this, if you want to use the label by the end of July, is very, very tight. If you were to want to change anything, because then you'd have to change, you know, be a material change in your prospectus, and you'd have to give 60 days notice. So immediately you'd have to do all your applications by the end of May. Fortunately, and like I said, I mean, what we do is very aligned with what the SDR, the FCA is looking for the sustainability impact label. What it does do, and I think it's helpful, I'll admit that it's definitely forced us to be clearer, you know, in terms of what is our objective, what is our sustainability objective. But we've never really framed that in a particularly tight, concise way, and so we're having to do that, and how that flows. This idea of like a stick of rock flowing through your investment process. How is your investment process designed to deliver against that? We have always done that, but it's forced us to be much clearer about that. Our theory of change is another thing that we have to be very clear about in the prospectus. So it's definitely helped us, I think, but it's not actually changed substantially anything that we do. We've always done it that way.
Yeah, great. I think the extra clarity in the prospectus will be really helpful. I think it's a very good discipline. So we've got time for maybe one more question. Last one that has come through is about which I think is probably for you, Vic, is whether there are any listed pure play recharging infrastructure businesses either in the portfolio or in our watch list.
There are a number of sort of listed charging companies, and we did do quite a lot of work around them. I think around about last year. One of the challenges for us was the uncertainty around how the business models would evolve. So some of them target actually selling the electricity as the way they make money. Some of them sell equipment. Some of them want to make money off software. Some of them sell advertising. And it was unclear how that would play out as an industry. A lot of them were pre-profit. And so we stayed away from them from that perspective. We do have, it's not a pure play, we do have a bit of exposure through one of our European companies within the European portfolio, but not within the main one. But you do have sort of secondary exposure through things like Schneider Electric that, you know, tie into the infrastructure, or potentially Silicon Labs, which I mentioned in terms of the connectivity, but nothing that is directly the equipment, because we think that might be more challenging.
Great. Thank you very much, Vic. We're pretty much on the hour. There is one last question that's just come through about the macro reasons for relative performance from web. Clearly, this has been a difficult period. As Vic has described, it's been very much related to the narrowness of the market focused around the Magnificent Seven and some of those mega cap tech stocks, and also the impact of interest rates, which has caused some disruption over a period of time. We don't expect that will last forever. We think we're very well positioned in the space that we have, and we think the fundamental drivers for the strategy, as Vic has explained, the fundamental performance of companies has remained relatively strong. And in the context of our opportunity set, our stock picking, our own performance has also remained strong relative to other, the impact universe and other impact investment peers. Obviously, we're delighted to talk more about that in direct one-on-one with everyone attending on the webinar. But we thank you very much for your support, for your attendance today. And I do encourage you, please, you will see as you dial off a pop-up asking you to give feedback. Please do complete that. Please do contribute to feedback. We look to how we can develop our webinars consistently in our client communications, and welcome all feedback on that. So please do. Thank you very much, everybody, for participating today. Any further questions, do please come to us directly. We'd be delighted to engage. Thank you.